Hey guys, welcome back to the Capital Mindset Show. This video is going to be a decently long video. It's going to be covering the financial sector, a long time video in the making. And the inspiration for this video came from my ex-co-host, Austin. His brother's invested in Goldman Sachs. From my understanding, he's done very well. He wants to know what to do with it. And I hope you guys appreciate this video. It's not going to be an in-depth dive, as in like everything you need to know, absolutely everything. There's always going to be more topics to cover with the financials. This will just be an introductory video. If we really wanted to do that kind of video, probably like, I don't know, like 10 hours long at the very minimum. And this hopefully will get a lot of you up to speed as to what to look at when it comes to financials. What are some of the important metrics that we want to look at? And also an appreciation for how complicated these companies are. And maybe you end up ending this video and saying, well, that's not for me. I don't want any exposure to that kind of stuff. We'll actually, when we look at the financial statements, you'll actually get that appreciation for how important these companies are for the actual system as a whole. And the companies we're going to feature today is Goldman Sachs, JP Morgan Chase, Bank of America. I could have just as easily added Citigroup. I could have just as easily added Wells Fargo and Morgan Stanley and et cetera. The reason why they're excluded is because I don't want to make this video too long, but I want to show you a little bit of the different flavors. I can do in the future smaller banks to show you guys a little bit of the differences in terms of their business profiles. But for the most part, I covered the biggest three in their respective fields. Obviously, I think Morgan Stanley and Wells Fargo and Citigroup are all very large banks, very important banks. The fact that they're not in this video is not anything to say about them. Okay. So with that being said, we'll begin with the price action of Goldman Sachs. And Goldman Sachs, again, has performed fairly well over the past 5 years. Most of this outperformance has happened more recently. And I'll tell you this, the financial sector as a whole has underperformed the broader index for quite some time. For the most part, it has to do with a lot of what I call sector scarring. So the whole sector has been scarred from obviously the 2008 financial crisis. Okay. And we'll take a look at that when we look at other price actions of particularly Bank of America. But as well, I think we can see here with Goldman Sachs right around here, you can see this massive drop. They have recovered. Bank of America is the only one that hasn't recovered yet of the ones that we're going to talk about today. And if we even pull up Citigroup, but regardless, over the longer term, it hasn't performed very well. General rule of thumb, we take a look right here at this PE. We'll actually take a look at what the new feature or the model can do for us. But the PE ratio is about 5.66. This is on a GAAP basis, and we have a dividend yield of 2.38%, about $113 billion company. All right. So let's actually jump into the financial statements of Goldman Sachs and see what they're all about. All right. So real quick, I want to actually take us first here. Return on equity, ROE, is a very important metric that we have to consider. So return on common shareholders' equity in particular was about 23% for 2021. And compared to 11.1% for 2020, immediately what goes in my head is there should be a concern that is this sustainable for the long term? Perhaps not. I think I call these anomalies, right? These are more akin to anomalies than actual regular old business performance. Okay, so we have to keep that in mind when we go forward into this analysis. And appreciate, by the way, if you look at me on the left hand, you can see how long this report is. They have a lot of information here, and I'm going to not go into all of this because I think, again, it would be too long of a video. I'm just going to be focusing on the big stuff. But I hope you guys can start to appreciate a little bit about how complicated these institutions really are. And we got a little bit of a taste for that when we were covering interactive brokers. Okay. And I just want to quickly scroll through this to show you guys about 500 pages. Not all that's actually necessary, right? I'm doing that for dramatic effect mostly. So thank goodness they have this because we can actually go here and, quickly get to the page that we really want to. And it's on page 124 out of 516. Okay. So right here, I want to break down their different businesses. You can see investment banking is their biggest business by a good margin. Then they have market making. So they are market makers, basically. They provide liquidity to the market. That's essentially what market making is, right? Depending on what industry, they're all lumping it into one. And we'll look at the different banks, how they kind of break down their revenues. But this is pretty simple and straightforward. Goldman Sachs was the easiest one to read. Interest income, interest expense, and, being a bank, we expect this. We do see that interest income has declined, more or less in line with interest rates. So that's fairly normal, that we would expect, right? And then we take a look here. I want to actually highlight this. Earnings per common share, $60 all the way up from $24 and $21. When we get to the cash flow statement of cash flows, I'll highlight that a little bit more. But looking at the assets, we see that they have 1.4 trillion in assets. And that's a large number. Remember, we looked at the stock price, or the stock market cap is 113 billion. This is fairly normal, not fairly normal. This is very normal for banks because they don't actually own this. A lot of this is matched up with their liabilities. If you can see here, the total liabilities is 1.3 trillion, right? And you take the difference, and that actually gives us equity. So shareholders' equity is about 100 billion. Right, almost more or less in line with the market cap itself. So when we take into account that the assets and the liabilities almost annihilate one another, it's not actually, that great, right? But that's not the point. They are financial institutions. They're like custodians. They hold assets on the books that aren't necessarily theirs, right? They hold other people's money. All right, so I want to also highlight, before we move on, I wanted to show this. Where is it? Compensation and benefits. So, I mean, we all know, for example, it is a stereotype that Goldman Sachs bankers do make a lot of money. Look at how much money they're making in total in compensation, about 17 billion off of a revenue base of 59 billion. So a lot of that's going into the compensation and benefits packages for these employees. They're very expensive. You have to pay a lot to get the best of the best, right? So here we go to the statement of cash flows. Right here, this is a general rule of thumb, and I've discussed this, for example, in insurance companies as well. You don't want to use net cash provided by operating activities as a goalpost. You actually want to use GAAP net income. GAAP net income, in the case of financials institutions, is a fair reflection. GAAP actually does a really good job at showing us a fair reflection of business performance. You can see here, there's a lot of cash moving in. These are actually negative cash balances. So you see that one year, it's a positive 94 billion. And another year, it's negative 70 billion, right? So that in and of itself should be a little bit of a concern, not a concern, but in another business, it would be a concern. Now, take a look at it like this, right? If there is ever a massive systemic risk to the overall system, you can kind of understand or get a feel as for why that's such a detriment, right? If at any given year, if they're having all these negative cash flows in total, cash is actually leaving. And let's say there's actual value destruction on the other end of the side of the collateral spectrum. Then at that point, this company is going to be caught with its pants off, and you can have a systemic breakdown, right, in these financial systems. That's what kind of occurred in 2008. So you can kind of start to appreciate the complexities of these businesses, right? One year they have a lot of cash coming in, one year they have a lot of cash leaving the bank, one year they have an overall, it should smooth out to something more along the lines of something positive if they're a good bank, right? And then we're taking a look here, the GAAP net income. The GAAP net income does a really good job at smoothing that out. While they are, expensing, like cash is leaving the bank, in some years, cash is entering the bank, in other years, that's not a fair reflection of the actual value created by those instruments, by those transactions. GAAP net income will do a good job of doing that. And we, again, talked a little bit more about that when we looked at something like interactive brokers and the complexities there. So that theme is going to continue into the future as we look at JP Morgan Chase and Bank of America, which actually we'll actually segue right into it. And JPM, this is known as the largest of the banks, right? And this one has performed better than the overall sector. And JP Morgan will be one of the first companies to tell you that. They'll be like, hey, we outperform the sector, the finance sector. So we're great. Awesome. So banks in general, again, the sector has underperformed, but JP Morgan's done really well. They are the largest. We have a $413 billion market cap. Again, a GAAP PE of 9.11, dividend yield of 2.86, right? So when we jump into their financial statements, again, appreciate how large it is, 393. Again, we won't look through everything, but they do disclose a lot of interesting values on their books, or not their books, their loan book up above. And again, they provide a lot of information, really good information. All right, but looking at the income statement, we see the breakdown is a little bit more detailed as to what it is. So we have investment banking fees, right? Principal transactions, lending and deposit related fees, asset management, administration, and commissions. This, by the way, principal transactions, I think that's the same as like or equivalent to someone like the market maker at Goldman Sachs. It's just called a little bit differently. You'll notice that some things are called a little bit differently, but more or less it's the same thing. We also have this one, card income, which actually, I don't know if Goldman Sachs broke that down because, they are the Apple Card. It might be in other principal transactions. It might be here. I have no idea. Interest income might be somewhere here. It might be somewhere in there, but for the most part, JP Morgan Chase is more famous for their credit cards. Like we have the Chase Sapphire Reserve, Chase Sapphire Preferred, all that jazz. That you watch credit card channels, you know what I'm talking about. And then we have investment securities gains and losses. And in this case, I had losses here, gains here, mortgage fees and related income. Obviously they have mortgages, interest income, interest expense, interest income. We see it. Yep. Same story. It's declining. But overall, they do make up for it here. They made a lot of money here in investment banking and fees. We can see that jump nicely over here. Will that continue? I don't know, but hopefully you guys can appreciate how large these institutions are. How many things are they involved in? And you can kind of get an idea for how important they are for the US economy, right? Especially as they are market makers, they provide liquidity for a lot of different markets. Like, think of it like this. I think it's quite obvious if you ask yourself this question. I'll actually zoom in because I need to remember to zoom in. Imagine if tomorrow Bank of America or JP Morgan Chase or Goldman Sachs goes bankrupt. What would happen in the overall US economy? Probably a lot of bad things. That would be not a good time. All right, so we take a look at the compensation expense, kind of the same thing. They do pay out a lot, $38 billion in 2021. 2020 was 34 and 34 also for that year. All right. Taking a look down over here, let's take a look at the balance sheet. Balance sheet, we'll see a lot of federal funds sold securities and purchased under resale agreements, the repo, about 261 billion, deposits with other banks, cash due from other banks. And then trading assets, securities borrowed, available for sale securities, held to maturity securities. So these are available for sale securities is quite literally the name. So they hold it on their balance sheet and they're actually looking to sell it, right? And then these words, net of allowance, allowance for credit loss. Allowance is an account. It's also known as a contra asset account, okay? So they don't list the contra asset account here. We might see it in Bank of America, I think, but they're saying net of the contra asset account, which means they've already done the subtraction. So when we have an allowance for credit losses, that is, again, a contra asset that is subtracted from the overall asset, which is the actual value. And then you get the net value, which is the total minus the allowance. And then we get what's called the net, which in this case is 308. All right. So they have a provision for what they think people will not pay them. Okay. And that's called the credit loss, right? If you're ever wondering why a credit card has, for example, high interest, is because they're getting compensated for the risk. And then obviously that bank or that institution will account for the potential of a lot of people not paying them back. And then that's, they're supposed to do that in a fair way. And then they account that in what's known as a allowance account. Okay. So contra asset. Investment in securities, allowance for credit losses. Here we go again, net of allowance. So it's already subtracting out what they think they will not get or what they think will be the end value. And then we have liabilities. As I stated many times before, a deposit in the bank is a liability to the bank. They owe you that money. It's a liability. And it's a current liability, by the way. And as for liabilities, we go from most liquid to least liquid, or most current to last current. Then long-term debt. This is the actual long-term debt of the bank, right? So yeah, fairly normal on total. Overall total liabilities. Same story for there. And then you can kind of see it's more or less the actual market cap of the business. So it's almost there pretty much. It's just a funny coincidence. So total stockholders equity is about 300 billion. JP Morgan trades at a premium to that equity, about 400 billion, but you know, more or less. All right. And let's go to the statement of cash flows. And I will tell you, it's the same exact thing. You can see here, sometimes negative, sometimes very positive. And then overall, this is a better picture telling us what the performance of the business is. A theme of all these banks is we have an anomaly year, a potential anomaly, and very concerning we're going to have to account for. All right. Taking a look at Bank of America. All right. Bank of America, we have the income statement broken down, interest income. So interest income is actually coming first. And then comes the fees, commissions, market making. You see, they call it market making again, and similar activity. So they bundle it all together. I see that they don't have a separate line item for credit cards, but I know they do have credit cards. And then compensation and benefits, you can see that it's also quite large. Okay, so we're zipping through this one because it's kind of repeating. Again, you'll see a lot of different or similar returning line items. Some of them will be a little bit different. I think in this one, they have the allowance separated, and then they have the net amount down here. So you see, that's the allowance right there. They're showing it in JP Morgan's balance sheet. They just gave you the net number. Here, they're breaking it down a little bit more for you. Some of you might appreciate that. Some of you might not care. Some of you might prefer the other way, you know. Again, loans held for sale, customers and other deliveries, other assets, total assets, right? Similar theme here, total assets there, total liabilities there. The actual equity is 270. And if we actually look at the price action for Bank of America, we can see that the market cap is a little bit at a premium as well. And I'll explain the premium in just a sec, but let me show you guys the total price action. So we saw this massive dip. This is the 2008 financial crisis, did not do well. Let's actually take a look at JP Morgan's. JP Morgan's reaction looks like a little blip, right? Because they were very well capitalized during that time period, and they only went down. Let me see. Let me actually measure that out. Yeah, fairly muted when compared to the other banks. All right, so Bank of America over the long period of time, this is Buffett's darling. Buffett prefers this bank. And I'll tell you right now off the bat, I also prefer this bank. I have a lot of relationships with Bank of America. I like a lot of what they're doing. And if I had to own only one bank, it would be this bank. Okay, but that's neither here or there. Currently, I do not own Bank of America. Obviously, it's not in the portfolio. That's public. You know, you guys could see that. All right, so let's actually, should we go to the model? Actually, no, we got to cover one more thing, and it was the statement of cash flows. Statement of cash flows right here. All right, so yeah, net income right here. That would be the better way. All right, from here, let's actually step into the model. So the model is going to show us some new, interesting, cool little features that I actually want to show you guys. All right, let's actually take you guys into the model. I think we'll start with Goldman Sachs. So Goldman Sachs GS, and let's let it load in. I'll show you guys some new, cool little features. So one thing I want to actually highlight is the complete. And yeah, there we go. Now it's updated. I was like, some of these stuff is still on the old one. Return on equity, 19.67%. And this is calculating off of the current base numbers. So, you know, we see a little bit of a drop from when they were reporting, but still really high. And this is what we're actually going to judge a lot of the banks on, return on equity. Okay. So the return on equity is fantastic. Buffett's talked about return on equity when looking at banks. I do agree with that statement. And right now, everything looks out of whack, right? Because what we're basically using is cash flows at the moment. So what we have to do is tell the model, and the model is almost like automating itself now, which is awesome. But we say over here, we say, yes, adjust the cash flows. Is it a financial institution? Yes. And now, here's the crux. We'll get to that in a second. I know some of your eyes zoomed over to the anomaly question, and the answer is yes, but we'll get to that. Right now, we're going off of a current base, right? The current base is a really high cash flow base. We can see right here, and the 2021 cash flow base is not cash flow, sorry, income base, and I'm not showing the income. All right, so let's go to the data sort. We can see it here. So in the income statement right here, we say net income is 21 billion. So we jump from 9.459 billion to 21 billion. And then that's what it's basically going off of, because I've answered the question. I told the model, hey, we're looking at a financial institution. And the model's like, all right, I got you. However, we have an anomaly, right? And I hope that kind of becomes clear. The anomaly is that 21.635 billion. So we have to normalize this anomaly, and we just ask the model to normalize it for us. And now once it normalizes, we get down to the actual figures where we have the potential to actually value the business based off of normal business functions, not some craziness that's going on in one given year or another, right? So now once we look at it from this perspective, things seem a little bit more tamed and more reasonable. And in fact, the actual market is actually pricing it at a conservative growth rate. So it's actually not priced super cheap, but it's still quite interesting. So let's assume some semblance of buybacks, because that's another thing I have to give in terms of context. Financial institutions, a lot of the returns they give to shareholders and a lot of their growth in EPS has been through the return of capital through buybacks, right? They've been reducing that share count, and the remaining shareholders are owning more and more of the business. And we actually take a look at from 2011 to 2017, revenues were actually fairly stagnant, right? But we see this cannibalization of shares over long periods of time. And this can actually provide a tremendous amount of value if executed properly. And that's the key question. Okay, so we can say that the book value, or the tangible book value, is actually fairly close to the current price. But the thing is, if a bad event occurs, if a downturn occurs, that book value is going to come down, and it's not going to look so cheap as it appears at the present moment. Okay, so just something to really consider. Okay. When looking at the current growth rates, I think these current growth rates are fair, right? On the high end, I expect 20%. On the low end, I do expect 2%. So if we expect a 2% growth rate, this is overvalued. If we do expect a 10% growth rate, we are kind of at fair. Well, it's undervalued at the present moment, and we are implying a decent margin of safety. So let's say if we want a greater margin of safety, you have to assume a greater than 10%, and we're basically between 10 and 13%. If I had to guess, it's probably at 11 or 12%. Yeah, it's basically at 11. Yeah, so it's between 11 and 12%. So I think that's a fair estimation on that part. All right, so let's actually move on to the next one on the list. And oh, let me actually quickly say yes to that. Let's move on to the next one on the list. And that will be JP Morgan Chase. I got to capitalize it because case sensitive. JP Morgan Chase. Okay. So with JP Morgan Chase, when it loads in, we say yes to everything. We say yes to the anomaly factor. Let me just tell you what happens if we say no. It will look a lot cheaper than it is, right? So then what we're telling the model here is we're saying, hey, there was potentially some anomalies. And then what it does when you say yes there is it looks through the numbers and then it will execute a series of mathematical equations that will detect whether or not there is a statistical anomaly. And then from there, try to proceed to correct it based on the programs I put into it. All right. So essentially what it's trying to do is correct for those things. And then it brings it back down to normal, what I perceive to be normal. And of course you see, it starts to make more sense because like, let's say I don't include that. Right? I don't tell the model to do that. You guys do realize that it looks extraordinarily cheap. It might be cheap, but it looks kind of weirdly cheap, especially when we consider that they might continue to buy back at about 3% per year, right? So JP Morgan Chase doesn't have to grow that much to achieve a 600% growth, right? Around there, 519 to be exact. I don't think so. I think the market's not really pricing that in. So once we account for the anomalies, which were last year, then at that point, it smooths it out. And then now it appears as though the market's kind of pricing in, decent returns. We're not in a fear session for the banks. That's what I'm trying to highlight. We're not at a point where these are very cheap. These were very cheap during the 2020s, right? Then they were cheap. Now they're a little on the expensive side, right? And this is again why I don't have really any of my banks left, right? I have taken all my profits. And I've taken my profits at higher prices, thankfully. The only one that remains is Citigroup. And I have received questions, but Citigroup's not being mentioned here, not because it's a bad company or anything like that. And I literally am going to be open with you guys. The only reason why Citigroup stayed is because of the speculation that the new CEO might fix things. And people like to say, well, Citigroup is always trading at a discount to book value, and therefore it's a buy, right? Because it's below book value. Well, that's only the case because they're not actually getting the same levels of return on equity as these other banks. And as we'll see, Bank of America, JP Morgan Chase, and Goldman Sachs all have much higher returns on equity than something like a Citigroup. Therefore, Citigroup should naturally trade at a discount relative to book value when compared to these other banks. Okay, so it's completely normal. And you're not actually getting necessarily that great of a deal with Citigroup. It's actually fairly priced. And I know Jim Cramer likes to say, it's below book value, blah, blah, blah. But the thing is, it's below book value at the present moment. Things can change. The risk of those assets are a little bit different, a little bit more risky on their side. So yeah. But anyway, they could improve things and they could improve that. And if they do improve that, then you could see that closing between the book value and the price actually happen, right? And that's the speculation, right? So it's not going to just naturally get there, right? There's a reason as to why. And that's all I'm going to say with that. So that's basically all I'll say for JP Morgan pretty fast. Because again, the focus is on the banking sector. Again, there can be videos eventually specifically about these and with an emphasis on Goldman though. So with Bank of America, more or less the exact same thing occurs because again, now it's normalized. And we can see that it's fairly priced, right? It's fairly priced for about the 10%-ish or less. And they haven't really grown that much in terms of revenues over the past time. But a lot of their returns, again, are geared towards that. But Bank of America, for me, is I think, one of the better priced ones because I think they're priced for lower growth, like 3%. Oh, sorry, not 3%. Why did I do that? 6%. I was thinking to subtract 3% from the 6% or 10%. Sorry. All right. So 6% doesn't cut it. What about 7%? 7% is around there. And then 8%. Yeah. So about 8%. So they're priced for the less amount of growth, right? They are growing less than the others, but they are buying back a ton more shares. Like let's hypothetically say they're able to buy back about 5%. per year. You can see there that that would return, that would be a buy right now, essentially, if you think that they're capable of growing 5% per year. You see like the shares are being cannibalized even more and more lately, right? So they had that jump in shares, and we can see that coming out of the financial crisis, that little jump there. And then since then, it's cannibalized a lot, right? Especially since 2018. That's a big jump down, okay? So awesome on their end, right? And again, this is Buffett's darling. This is Buffett's favorite. So analysts have this one at a strong buy, price target 89.07, a country, United States. We don't care about that. And then sentiment is actually positive. Okay. So I didn't actually check out the sentiment for the other guy. So I'll go ahead and do that. Let's pull up Goldman Sachs. Goldman sucks. I'm kidding. All right. There we go. Goldman Sachs. Remember, oh, and you saw Bank of America, by the way, the return on equity was around 11%. So a lot less than Bank of America and Goldman. So obviously it looks cheaper. It trades cheaper because it should be cheaper. And also, if you guys haven't noticed, because I'm forgetting to highlight that the Altman Z-score and the bankruptcy analysis do not work for banks, because of course they're always at risk of bankruptcy. If something big happens, they're going to get shafted, because we just took a look at their financials. And I hope you guys can appreciate a little bit the complexity that goes into those entities. And at any given moment, if something bad occurs, regarding the whole system in general, they will probably get caught with their pants off. By the way, it's looking at as a buy because I assume Bank of America's level of buybacks. Remember, they're probably going to maybe, let's say it's 3%, right? And in that instance, Goldman is fairly cheap. But again, we are assuming only growth rates. They might decay, right? And which is very possible because their anomaly factors huge, right? But they might, only buy back 2%. And then again, if you want a higher discount rate, then, you'd have to assume that. But, and let's say they buy back 0%. You can see how that affects it. A lot of it is determined on how many shares they can actually cannibalize over long periods of time. All right. Sentiment is still positive. And then we'll just finish off JP Morgan Chase. And then I'll have some closing thoughts. I'll talk a bit again about the risk factors and the like, and then conclusions. All right. So JP Morgan is the only one below 1. Interesting to know. All right. So, yep, that's where I'll conclude with that. So the risks associated with the financial sector is, of course, systematic risk. That's quite obvious, right? Anything that can occur that could knock down the whole system is, of course, very risky to the banks because they will be caught with their pants off, right? So they are integral to the US economy. These particular banks, they're integral to actually a lot of the world's economy. And so a lot of governments won't probably allow them to fail because they're so integral. I like to say that banks are the heart of an economy and the money is the blood. So the banks pump the blood, which is money, throughout the economy and allow things to grow and develop, right? Without the banking system, there would be a lack of growth, right? So one of the things that is a hallmark of a developed economy is a strong financial and banking system, right? Because that is the heart of an economy. Okay, so more of the risks associated with, let's say, interest rates or Federal Reserve policy. Well, the Federal Reserve and buying safe and liquid assets such as treasuries is something that the banks have preferred more and more to do because, again, those are safe and liquid assets, right? Because what they care about is preserving the nominal terms of those dollars because their liabilities are derived or denominated in those dollar terms. So if they can match those liabilities with a safe and secure asset such as a treasury, they would more than be happy to do that. A lot of people don't understand that. And they say, well, why are the banks continuing to buy treasuries in the sight of a massive inflation? Well, because again, those are safe and liquid assets and they perfectly match their liabilities, which are also denominated in the same dollars, right? So if they do that, they make a profit from the top, right? They take a profit from the delta between the production of those assets and the difference of those liabilities that they owe, right? So when the bank owes you money, that's their liability. That can be in any form of debt or, in the form of your savings account, checking account. And then when they take that money and they go buy a safe and liquid asset for a short-term duration bond, they can generate a little bit of income and that's all theirs. And then they share with you a little piece of it, like 0.05%, for example. So that's the name of the game. Banks are very complicated businesses. And this is only just scratching the surface. Just keep that in mind. but hopefully this video did provide you guys a good amount of value. I will also be doing a video shortly on a request to read an article regarding the potential of a recession. I made a promise to a subscriber a while back in one of the live streams, and then I'm going to be sure to get that out for you guys today. So I hope you guys enjoyed this video. Again, if you did, feel free to leave a like, subscribe if you're not, and come back to the channel. We might be talking about a stock that you're particularly interested in, and I can shed some light on my perspectives, at least I'm looking at it. On that note, guys, I hope you guys have a great one. I'll see you guys on the next one. Bye.